Ask
All
your
right.
questions.
So what kind of loan can I use for an investment? That's as basic as I can make it right now.
What kind of loans can you use for?
So I know we spoke yesterday about FHA, which is that technically an investment if you're doing a multifamily kind of?
No, it's owner occupied.
Right. So then this is just strictly for if you're not living in the crib and you want to invest and be more landlord, right?
Mm-hmm.
Okay.
Correct. You have no intention on living in the property.
No intention.
Correct.
All right. So let's say, so how much money you have to have for that then in order for you to get into this kind of, investment?
So depending on the property type, right? So first of all, you have residential investment properties, which are 1, 2, 3, and 4 family properties. Condos as well, but I really don't like condos because it's HOAs.
Okay.
And HOAs, home ownership association dues and stuff like that. It's kind of, they run your life, kind of, sort of. And depending on where that property is located, those fees can be pretty expensive. So I don't really like condos for investments. But 1 to 4 family is residential, and anything above a 4 family, so 5 units or more, is considered a commercial property. So
I didn't even know that. Okay.
Okay, so good. You learn something new every day, right? So there's 2 type of lanes.
Okay.
Now, when it comes to funding these deals, in the residential space, you have 2 lanes you can pretty much go. You can go full documentation, which means you're qualifying for the loan yourself or for your merits, right? Your income, your assets, your DTI, it's in your personal name. You're using a conventional mortgage out of the Fannie Mae or Freddie Mac backed loans to buy investment properties. Now, these loans will require, again, like I said, full documentation, meaning you're submitting all your documents like you're buying a primary residence.
Okay.
Right? So that's what when I say full documentation, that's what I mean.
That's okay. Gotcha.
Right? That means, so if you hear me say full documentation, I'm really, or it's in your name, that's the conventional route. Now, depending on the property type, if it's a 1 family or a condo, you can put as less as 15% down for a true investment property.
That's minimum.
Minimum down payment.
So yesterday, FHA was 10%.
3.5 for
FHA. But I'm sorry, in terms of
I
money.
saw all cash to close. We didn't get the cash to close.
Okay, all right.
Let's not confuse yourself yet.
Because I got those numbers in my head. I'm like, all right.
Yeah. So yesterday's look, everybody in the class, forget yesterday's conversation.
Yeah, okay.
Yesterday's conversation has nothing to do with today's.
I know, but I'm trying to have the switch in my head. Like, all right, that's FHA. That's like if my first crib. This is just investments.
This is investments.
So those are like the standard. That's like the baseline for me. It's like, all right, cool. If I want to do that, 10%, 3.5.
Always remember, closing costs is what percentage?
5%.
Yes, 5. Okay, 5. Investment, it could be 7%.
Okay, it could be, or
it could be.
Okay, all right.
Because there's more fees that come with buying investors because now banks have to charge you points, origination fees, things of that nature. So buying an investment property could be a little bit more expensive, right?
Right.
So if I tell you, or for a single family or a condo, the minimum down payment is 15%. For your cash to close, you got to think I need 22%. Because now you got to incorporate what the fees could potentially be.
Right.
Right? And for a multifamily, 25% down.
Okay.
All right? Plus the closing costs. So your total cash to close will probably be 32% of the sales price, basically. Right?
Okay.
Now, that's the conventional route. Now, when you're doing conventional investment properties, one of the cons is the amount of documentation that you have to submit it in. It's in your personal name. Deed is in your personal name as well. So there's no, you can't put it in the mortgage in your LLC, but you can, since you're buying it and structuring the deal as an investment property, some lenders, because Fannie's guidelines will allow LLC on a deed because it is an investment property. Some lenders might have overlays to that. You just got to check the lender that you're working with. But you could potentially put the deed in the LLC's name, but the mortgage will still be in your name for conventional investment property, right? Now, some of the cons of using a conventional mortgage is, like I said, it's in your personal name. You have to qualify based off of your income in your assets,
Okay.
right? If you don't have rental income or landlord experience, you can't use rental income to really qualify. It's not
Right.
so. It's not like when you do a FHA, it's owner occupied. You can use that rental income to help you qualify.
Right.
When you get into the investment category, if you don't have the experience, then no. So
Okay.
you have to personally qualify for the property
Right.
if you're going conventional. That's a couple of, and also from a paperwork perspective, I would say a con would be the amount of documentation that you have to submit to get approved for this type of loan, right?
Right.
Now, the pro, I would say, with using conventional would be interest rate compared to buying it in your LLC, which I'm gonna go over in a minute.
Okay.
So today's rates for investment property, if you're talking conventional financing, will probably be somewhere between 7 and 8.5% on a 30-year fix, just depending on the lender, right?
That's
Depending
a
on,
pro.
trust me,
Okay.
we're gonna
I
get there.
trust you. I trust you.
So let me say this: if you're buying a single family home today, you're gonna be in that low sixes, maybe
Okay.
high fives,
Okay.
right? If you're buying a multifamily, going conventional, you're going to be in the high sixes probably,
Mm-hmm.
maybe low sevens. So now when you talk investment properties for a conventional financing deal is always going to be higher
Right.
than what a traditional primary residence would be. You got to figure by at least a point and a half, just depending on the lender
Yeah.
and what their risk tolerance is for the deal. So typically, the pro is lower interest rates compared to buying it in your LLC because the LLC rates are always higher than what conventional rates are.
Okay. Got you.
Got it?
Right.
So that would be a pro, but we're in the market today where conventional interest rates on investment properties and financing them in your LLC are pretty much on par with each other. So now let's talk out. And with conventional, you will need a minimum of a 620 credit score.
Okay.
And another pro of it is there's no restrictions for first time investors, right? So if you're a first time investor, hey, you may not be able to use the rental income to qualify you, but you can still buy an investment property and get funding if you do qualify. They won't say no first time home buyers allowed.
Okay.
You
Got
see what
you.
I'm saying? So you don't have to be a current homeowner
Right.
to buy or get funding from a conventional Fannie Freddie deal with buying an investment property. Now, on the flip side, when you go with the LLC and you're dealing with portfolio type of lenders,
Mm-hmm.
these lenders now will probably have that requirement. I have several lenders that won't even do a deal for a first-time home buyer buying an investment property as their first deal.
But with their LLC.
With their LLC, it doesn't matter.
Okay.
They don't own shit,
Right.
so they don't trust them,
Right. Right.
right? And they can make these decisions, right? So the pro, again, for the conventional, you don't have that. So if you run into problems with finding funding, you might have to go conventional, get on the scoreboard. Now you have the experience because you own the property, and then now you can flip to the next deals, do it in your LLCs.
Okay.
Now, the pros with financing deals in your LLC is you don't have to submit tax returns, W-2s, pay stubs. You have to run your credit because you, as the owner of the LLC, will have to personally guarantee the debt, but the debt in the deed is automatically going into your LLC's name,
Okay.
right? So it's less paperwork because the banks, when we underwrite it, we're looking at, and again, the book has all this in detail, chapter 5 to be exact. Analyze before you buy your real estate investment, right? Chapter 5 got everything you need. But the property is what we're looking at to see if it cash flows, right? So if the property can cash flow, then you can get approved for funding. Even if that LLC is a brand new LLC, no business credit established, it doesn't matter because it's the property that the underwriters are looking at when they're doing this type of deal. It's not you, Tukes.
So that's more like security for them to see if like, because if the property's going to cash flow, then
Yeah,
They're gonna get
then
them.
we feel comfortable
Right.
because this is an investment.
Right. Right.
You know
Right.
what I'm saying? This is not like some first time you're buying your first house as a single family or something like that. Like,
Yeah.
it's a different mindset,
Right.
right? There are banks out there that are strictly focused on working with investors, period, point
Mm-hmm.
blank. They won't even work with people who are buying in the traditional market. Their goal is to only help investors scale, because
Okay.
investors are always going to invest. Home buyers are going to buy one house. Investor
Yeah.
might buy one a month. You know what I'm
Right.
saying? So these programs are out there for investors to be able to go in, make offers, get funding, close, and continue that process.